Why is pound trade-US dollar falling today? Weak UK PMI data and resurgent political uncertainty have sent the pound below 1.3250, but more importantly the yield spread between gilts and treasuries is widening in favour of the dollar, giving this move a structural backbone. The British pound just dropped almost 60 pips in a matter of hours, and the real selling hasn't even started yet. Right now there is one danger zone and one hidden opportunity in cable. I'm going to show you both. If you're looking at this chart and thinking about catching the bottom, you are stepping directly into a trap that the data told us was coming 3 days ago. But if you know exactly where the structure resets and where the liquidity sits, today's move is one of the cleanest setups we've had all month. Stay to the end. I'm giving you 3 exact levels you can trade today: sniper, active, aggressor, with precise entries and stops, and a wildcard event tomorrow that could either accelerate this collapse or spring the mother of all short squeezes. Write down 1.3140. That number is going to decide everything. This is your instant market verdict. The bias is strong sell. Across every single time frame, monthly, weekly, daily, 5-hour, 1 hour, the trend is unambiguously bearish. The ADX just printed 34.1. That is not a random reading. That is a momentum regime shift. The trend is strong enough that dip buyers get chewed up and mean reversion strategies fail repeatedly. The session is trending. Not fading, not range-bound. Now, I need you to write this number down somewhere you can see it. If we break and close above 1.3250 on the 4-hour chart, the entire bearish structure resets. Everything I'm about to show you becomes invalid on a sustained move back through that level. But until that happens, the path of least resistance is down. Here's what the herd is doing. They are looking at the RSI, seeing it near 34, and thinking oversold bounce. They are already buying, trying to catch a knife, and that's exactly why this still has fuel. The liquidity pool below 1.3190 is enormous. The smart money is not fading this. They're adding to shorts on any pop into the pivot. Align with the momentum, not against it. If 1.3250 breaks to the upside, we flip neutral. Right now, we are in a trending sell structure, and the bears are in full control. Let's take a deep technical dive, and I'm going to walk you down from the weekly right to the 60 minutes so you understand why this is not an ordinary dip. This is a structural breakdown. On the weekly, we have a strong sell signal, and price is sliced through the 20-week moving average like butter. That moving average sits at 1.3337, and it is now sloping lower, adding bearish pressure. The 200-week moving average is a bit higher at 1.3376, and it, too, has started to flatten. When you see the 20-week crossing below the 200-week on the horizon, that's the setup for a major long-term bearish phase. On the daily chart, we are below every single moving average I track. The 5-day at 1.3243, the 10-day at 1.3280, the 20-day at 1.3337, the 50-day at 1.3398, the 100-day at 1.3410. The moving average stack is perfectly aligned for a sustained downtrend, and price is trading below all of them. That is an institutional-grade bearish alignment. The daily MACD is negative at minus 0.006, and the histogram is still accelerating lower, no bullish divergence whatsoever. In fact, what you have is a bearish continuation signal on the MACD line crossing firmly below signal, and it's building steam. The daily RSI at 34.6 is not screaming oversold. It's telling you there is still room. Many people wrongly think RSI below 30 is the only buy zone. But in a strong trend, RSI can spend days in the 20s while price cascades. Now come down to the 4-hour chart. This is where the real battle is. The MA20 on the 4-hour is at 1.3337, exactly matching the daily 20. It's a brick wall of resistance, miles above current price. The 50-mile on the 4-hour is at 1.3398, even heavier. Price is hugging the lower band, and the MACD is firmly negative with no bullish crossover in sight. But here's what most traders miss: the hidden momentum signal that is driving this entire move. Pull up your CCI on the 4-hour. It's at minus 121.6. That is deeply oversold on a short-term oscillatory scale, but in a powerful trend it's a signal of acceleration, not exhaustion. And the ADX at 34 confirms this is a trending environment, so oversold signals get steamrolled. The real hidden signal is on the hourly chart RSI. It's at 34.6, having not yet entered genuine oversold territory despite a 100 pips drop. That means momentum is strong enough to push much lower before any mechanical mean reversion even starts to trigger. Combined with the Williams %R at negative 89.7, you're seeing an oscillator that is buried, but that only tells you the short-term extension is extreme, not that it's over. In trend, extremes beget more extremes. Now let's talk support and resistance levels. Current price is 1.3196, barely holding above S1 at 1.3194. This level is the immediate floor. A break below here, confirmed by an hourly or 4-hour close, opens the door straight to S2 at 1.3140. Below that, S3 is the psychological 1.3100 handle. Resistance above is layered. The pivot point for today sits at 1.3234, which is also just below the 5-hour moving average. Above that, R1 is 1.3288, R2 1.3328, and R3 1.3382. Notice that A1 lines up almost perfectly with the 10-day moving average, making the 1.3280 zone a formidable ceiling. If you are selling rallies, that's the structural roof. But let me give you a cross-linkage that's even more important. The pound is supposed to be a dollar killer, that's its character, but right now it's being hunted to extinction because UK gilt yields are collapsing relative to US Treasury yields. Real yield differentials are moving tick for tick against cable. Watch the yield spread between 10-year gilts and Treasuries. It's widening to levels that directly map to a move toward 1.3100. This isn't just technical, it's a macro unraveling. When yields kill the pound, dollar killers become the victims. What changed everything in the last 24 hours was the UK PMI print. That data came in weak, much weaker than the market was braced for, and it immediately pushed sterling through the 1.3250 support that it held for days. The pound was already under pressure from UK political uncertainty, and then PMIs took the final underpinning away. The services number, in particular, hinted at a slowing economy, and that forced a repricing of Bank of England rate expectations. Here's what's priced in now, a very dovish bow, with rate cut probability jumping across the next few meetings. But here's what is not fully priced in, the possibility of an emergency-style slowdown that forces the bow to move faster than the Federation policy divergence is the engine of currency moves. And right now the Fed is still leaning hawkish, holding rates, while the bow narrative is turning unmistakably dovish. That spread is widening, and cable is the pressure valve. The 2-week directional lean is decidedly bearish. I see a high probability of a test of 1.3100, and if momentum continues, 1.3030 is not out of the question. The exact invalidation for this macro view is a daily closeback above 1.3382. That's a 3 and the high of the range before the PMI shock. If that happens, the narrative switches to a false breakdown and a sharp squeeze. Now I want to trigger an interaction right here. Do you think the pound breaks 1.3100 this week? Comment yes or no right now. I'm going to be tracking the consensus and showing the results in tomorrow's video. Now, this is the moment most people click away, and that's exactly where the money is made. Stay with me. We are going into 3 trade setups, and I need your full attention. I'm going to give you exact numbers for entry, stop, take profit, and invalidation, and I want you to screenshot the on-screen trade cards. If you trade nothing else today, these plans will keep you on the right side of the move. First, the sniper, conservative plan. This is a structure-based short that waits for confirmation of the breakdown, and then enters on a retest of freshly broken support. The trigger condition is this. We need a 4-hour candle close below 1.3190, confirming that S1 at 1.3194 has been cracked. Once that close prints, we wait for a retest of that broken support as new resistance. Look for a 1-hour bearish rejection candle, a pin bar, a bearish engulfing, or even a failed auction above 1.3195 that gets rejected. The entry is at 1.3195 on that rejection. The stop loss sits above today's pivot and the short-term structure at 1.3240. That's 45 pips of risk, well within the daily ATR of 89 pips. Take profit 1 is set at 1.3140, which is S2 and a major demand zone. That gives you 55 pips of reward, roughly 1 to 1.2 R. But the reason this is a sniper play is because it runs to take profit 2 at 1.3100. That's 95 pips from entry, giving you a risk-reward ratio of 1 to 2.1. Once price hits take profit 1, move your stop to break even. Invalidation for this entire setup is simple. If a 4-hour candle closes back above 1.3250, the breakdown is a trap, and you exit immediately. Look at the screen now. Here's the trade card. Screenshot it. The sniper, conservative, entry, 1.3195, 1H bearish rejection after 4 hours close below 1.3190, stop loss, 1.3240 take profit 1, 1.3140 take profit 2, 1.3100 risk, reward, 1:2.1 R invalidation. Void if 4H candle closes above 1.3250. The second strategy is the active trader, standard plan. This one is for traders who want to sell into intraday rallies and use the mean reversion against the moving averages. As the price has fallen so fast, it will inevitably try to bounce and correct some of the oversold readings, and that bounce is your entry. We are looking for a pullback to the 5-hour moving average, currently at 1.3243, which also sits right around the pivot. The entry condition is a tag of 1.3240 to 1.3245, with a bearish stochastic cross on the 15-minute or 1-hour chart showing the bounce is running out of steam. Entry is at 1.3243. The stop loss goes above the 10-hour moving average and the R1 resistance at 1.3290, so set the stop at 1.3290, giving you 47 pips of risk. Take profit 1 is set at S1, 1.3195, for a quick 48 pips and a risk reward of roughly 1 to 1. But we are not trading this for 1 to 1. We are leveraging the trend. Take profit 2 is at 1.3140, which offers a 103 pips move. Once take profit 1 is hit, trail the stop to break even and then trail by 20 pips behind price. This allows you to capture a potential extension down to S3 without giving back the initial gain. The invalidation is a 1-hour close above 1.3290. If that happens, the corrective bounce turned into something more and you stand aside. On screen now, you have the active trader plan. Grab it. The active trader, standard, entry, 1.3243, pullback to MA5 on 1H, bearish stochastic cross, stop loss, 1.3290 take profit 1, 1.3195 take profit 2, 1.3140 risk, reward, 1:1R to TP1, 1:2.2R to TP2 invalidation. Void if 1H close above 1.3290. Before I go to the aggressor plan, I want you to do something. Type your cable range for tomorrow in the comments right now, high to low. I want to see who's aligned with the structure. It tells me whether you're reading the volatility correctly. Drop your numbers below. Now the third strategy is the aggressor, high risk, high reward. This is for traders who can lose small and manage risk with surgical precision. It's a momentum chase, no waiting for pullbacks, striking while the waterfall is active. The entry trigger is a 15-minute break and hold below 1.3185. That's below the current intraday low and signals acceleration. Once we see a 15-minute close below that, you sell at market, entry around 1.3185. The stop loss is tight, 1.3205, just above the nearest minor resistance, giving you a 20 pip risk. Take profit 1 is 1.3140, 45 pips away, for a risk reward of 1 to 2.25. If momentum is truly runaway, you can hold a runner to take profit 2 at 1.3100, but you must move the stop to break even once TP1 is touched. This is a high-octane trade. I want to be absolutely clear. Only for those who can accept being stopped out quickly and who can afford to take multiple small losses. If the 15-minute candle reverses and closes above 1.3205, the setup is void and you exit without hesitation. The trade card is on your screen now. Snap it, the aggressor, high risk, entry, 1.3185, 15M close below, stop loss, 1.3205 take profit 1, 1.3140 take profit 2, 1.3100 risk, reward, 1:2.25R to TP1 invalidation, void if 15M candle closes above 1.3205. Let's do a quick risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news events. And tomorrow we have a very high-impact UK event, so plan accordingly. Stops are non-negotiable. They are what keep you alive to trade the next big move. Survive today, thrive tomorrow. So here's the close and your retention loop. The single most critical level for the next session is 1.3140. That is the pivot point between a manageable correction and a full-scale collapse toward 1.3100 and below. If we hold above it on a daily closing basis, the bears might need to regroup. If we slice through, the selling accelerates. Tomorrow's wildcard is the UK Services PMI, and that data is going to be the catalyst. A bad print will validate everything I've shown you and likely push cable into the 1.3100 zone within hours. A surprise beat, however, could trigger a vicious short squeeze back toward 1.3250, and that's exactly why your invalidation levels matter. You need to know before the news where the traps are set. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Tap the end screen and it will take you directly there. Smash like if this gave you a clear plan, subscribe with the bell, and I'll see you in the next one. Trade smart.